Hi, welcome. So this is going to be a class about home buying. And even though it's called Buying Your First Home, boy, there's so much to know about buying a home that even if this is your second or third, I hope that you'll find this information valuable. So I'm that you're here. I will start with a little info about me, and then we'll move on to the reason you're here, which is to learn about buying a home and understanding the process. So I'm Kym Mason, and I'm an area manager for Cornerstone Home Lending. I've been a loan officer since 1999, and in that time, I've served more than 1,600 families as their trusted mortgage advisor. I've always worked by referral, and I get to meet the best people that way. So I have found that good people know other good people. So I hope that you will find value in this class, and then you will share it with your friends and family, and perhaps refer them to me if you feel like that would be a great value for them too. So let's start with our goals for this course. Uh, what we're going to do is learn the advantages of owning a home. We're going to explore the different loan programs. We're going to discuss the costs of being a homeowner. We're going to understand how credit scores affect your option. We're going to talk about how to complete the pre-approval process. And I know that we won't have every answer to every question that you have within this class. So my team will be available for those questions that you have that aren't addressed. So let's start talking about why you would want to buy instead of rent. So you're going to pay for housing one way or the other, unless you're living rent free. And hopefully, if you're doing that, you're saving up for a down payment. So you might as well make that monthly payment work for you. Owning a home is a wise investment. Homes typically increase in value, and over time, the value of your home, as it grows and appreciates, the difference between what you owe on the house and what the home's value is called equity. So as the value increases, your equity increases. And here's an example. If you buy a home for, say, 400,000, average historical appreciation, let's say it's 6%, that means your home will earn $24,000 in appreciation that first year. So this is a way to build wealth simply by making your monthly housing payment, and you would have had to pay for housing anyway. Also, the interest that you pay on your mortgage is typically tax deductible. Now, of course, owning a home is more fun than renting because you get to make it your own. So you can paint the walls and you can change the landscaping and you can personalize it however you want because you own it. So it can provide more room for a growing family or a yard for a dog. And a starter home is a great way to build wealth and save for the down payment on the home that you really want. Your home will appreciate each year, and in a few years, there will be enough equity for you to sell it and then use the proceeds for a down payment on the home you really want. So you would have been making housing payments anyway. You might as well build wealth and be able to move up into that home that you really want in just a few short years. So you're either paying your mortgage or someone else's. Better to pay your own and build wealth for yourself instead of someone else. Let's talk about how to begin. First, find your home team of experts. Then you'll need a good real estate agent, a trusted mortgage advisor, and a reliable insurance agent. You'll then complete your loan application and collect all the necessary documentation. Your loan officer will provide you with a list of needed items. For example, some of the items on that list will be pay stubs and bank statements. Then you'll explore your loan options, and your loan officer should create some strategies for you to explore which option is right for you. And then you're going to consult with your realtor and find out what's available, where do I want to live, and when can we start shopping. So let's talk about the basics of homeownership and getting approved. Here are the factors of pre-approval: your credit history, your employment status, your qualifying income, your existing debts, and your down payment. So what determines your credit score? Well, new credit and types of credit, the length of your credit history, the amounts you owe, and your payment history. So, the key to achieving a good credit score is how much you have on credit and what your payment history on those debts is. So, are you maxed out on credit cards or other loans? Do you pay your bills on time? How many accounts do you have? It's always best to have at least three trade lines open and in good standing. So if you have accounts at zero balance, don't close them. It helps your score to leave them open if they're in good standing. So if you have a credit card, you should always keep the balance at 30% of the limit or less. And you need to use it in moderation and then pay as much as possible on the balance every month. Now, your FICO score, as it's called, is an indicator of how you manage debt. So, if you have a history of making payments on time, it's a good indication that you'll make your mortgage payment as expected. Your credit score can also impact your interest rate and how much a lender requires for down payment and the amount that you can borrow. So, the good news is you do not need an 800 FICO or 20% down to purchase a home. So, how much do you need for a down payment? Well, it depends. Today, there are loan programs with flexible down payment options, including low or no down payment. And some home buyers might be eligible for down payment assistance. Now, of course, the amount you put down will impact your mortgage payment. So, if you want a lower mortgage payment, then of course, putting money down is helpful. Now, that's why having a consultation with a trusted mortgage advisor is the first step toward becoming a homeowner. So, how much house can you afford to buy? Well, one criteria used in qualifying for a home loan is your debt to income ratio, also known as your DTI. So, your debt to income ratio is typically the anticipated total housing payment plus your existing debt payments divided by your gross income. Now, that's a lot. So your loan officer can calculate that for you. That's what we're here for. And your loan officer is going to review your DTI ratio and review which loan programs you can qualify for. The key is to get pre approved so that you know exactly how much house you can afford. So, what's included in your mortgage payment? Well, your mortgage payment is determined by four things, often referred to as PITI. So your loan balance is number one, and that's known as principal. Number two is interest, the interest you're paying according to your interest rate. Number three is your property taxes, and number four is your homeowner's insurance. And depending upon the loan program, there might also be PMI, which is private mortgage insurance, and that might also be included in your monthly payment. And that does apply to most homes if you put less than 20% down. So now let's talk about which loan is the right type for you. So when talking about loans, the first step you could take is to learn about two basic classifications of home loans, conventional and unconventional. So unconventional loans are often called government loans. And each type of loan has its advantages and disadvantages for the borrower. So let's take a moment and explain the main differences. So, conventional loans are your standard non government mortgages. Conventional loans are not guaranteed by or insured by a government agency, such as the Federal Housing Administration, FHA, or Department of Veterans Affairs, VA, or Department of Agriculture, USDA. Now, conventional loans are backed or insured by Fannie Mae and Freddie Mac, the two largest investors of conventional loans, and they have specific loan underwriting criteria. So they've invested in nearly half of all US home loans. So they're important to home buyers and potential buyers alike. Now, conventional loans typically have a lower debt to income ratio and higher credit score requirements than unconventional loans. So, lower credit scores can mean higher interest rates on a conventional loan. And if you're putting less than 20% down, you'll need mortgage insurance, which tends to carry a higher cost as compared to unconventional loans with less than 20% down. Conventional loans are also known as conforming loans because they conform to the rules set forth by Fannie Mae and Freddie Mac. Now, types of conventional loans include conforming, and conforming is the term used to describe loan limits set by Fannie and Freddie. And some areas of the country are considered high cost areas and they have higher loan limits. So, non conforming loans are loans that are not backed by Fannie Mae or Freddie Mac, or they exceed the conforming loan limits. So jumbo loans, for example, are a type of non-conforming loan because they exceed the conforming loan limits. Now, fixed rate loans are the most common choice. The interest rate stays the same for as long as you have the mortgage. Most buyers choose a 30-year fixed rate because it usually results in an affordable monthly payment. But shorter terms are available, for example, a 15-year or a 20-year. Now, adjustable loans, ARMs, as they're usually called, have rates that may go up or down over time, and adjustable rates usually adjust annually. So, once a year after an initial fixed rate period that is typically 5, 7, or 10 years. So, you've heard the term like a 5-1 ARM. That means it is fixed for 5 years and then it can adjust every year after that. Now, let's talk about unconventional loans that are backed by the US government or local state agencies. So, when we talk about unconventional loans, we're typically referring to FHA loans, VA loans, and USDA loans. So, with those unconventional loans, including the government programs we just discussed, as well as local bond programs, let's talk about bond programs for a moment. Bond programs are used by city and local government to help fund down payments and lower the cost of buying a home for community members who might otherwise not be able to afford it. These types of loans offer assistance with down payment, but they often have higher interest rates or fees and stricter income guidelines. So you just have to weigh the pros and cons. Now, an FHA loan offers more flexibility for credit and income qualifying. They do have a maximum loan amount, though, that is set per county, and they do have mortgage insurance included in the monthly payment that is for the life of the loan. So you have to refinance to get rid of that mortgage insurance. Now, a USDA loan offers a zero down option, but they do have income limits and they're only available in specific areas because they're designated for areas considered rural. But you can check that on the USDA map online and find out if the area that you're interested in is eligible for USDA loans. Now, VA loans are backed by the Department of Veteran Affairs. They generally do not require down payment and they're more flexible for qualifying, but veterans and active duty personnel who secure a VA loan do need to certify that they intend to occupy the property as a primary residence. So, saying that they're going to live there. Okay, so let's talk about which loan is the right type for you. We've discussed a range of finance and down payment options, and interest rate is only one component to your home loan, but it's the one that people ask about first. So just by knowing all the other factors to take into account, you already know more than 99% of the home buyers out there. So give yourselves a pat on the back for that. And it's important to work with a trusted mortgage advisor so that you can select the loan that best suits your budget and your goals. Because as you can see, there's a lot to know. So now that you have an understanding of the loan programs available, let's take a look at the home buying process. There are 6 steps to the home buying process. So step 1 is complete your loan application, provide income and asset documentation, and get a pre-approval letter and share it with your agent. Step 2, review your pre-approval with your realtor and discuss your purchase options. Formulate a plan to see the homes that fit your budget and your needs. And step 3, start your home shopping, the fun part. Stay focused, don't get discouraged, always stay in contact with your realtor and your lender, and don't engage in any large spending or obtain any credit during this time. So this part's really important. You want to keep your income and asset and credit picture the same. And so if you're going to change jobs, for example, or make a large deposit, or perhaps a family member offered to gift you some money toward the home loan, you want to be sure and discuss all those things with your lender so that we can help you formulate a plan, make sure you stay on track with your pre-approval. All right, congratulations. You have found the home you want to buy. Now, here are the final 3 steps on your journey. Step 4, work with your realtor to make an offer. Review the offer with your lender and update your pre-approval letter as needed. Submit your offer with an earnest money deposit. Now, your realtor can advise you on how much earnest money is reasonable. And this is going to be money that you put into escrow that lets the seller know you're serious about this offer. And step 5, you're going to have a property inspection and order an appraisal. You're going to collect all updated documentation, so like your income and asset documents if they need to be updated, and you're going to acquire homeowners insurance. And if you need a referral for that, you can ask your realtor and your lender, and they probably have someone they can refer you to. And then your loan is reviewed for final underwriting. Step 6, receive your final loan approval, review your final closing statement, and coordinate with your lender. And then attend your closing and get the keys to your new home. That's the best part. Now remember, you're almost to the finish line, and it's important to consult your lender regarding any significant expenditures or changes to your job situation while you're in the process of buying your home. So let's recap. Congratulations, you are now an educated consumer, and let's review the key points that we discussed. The benefits of owning versus renting, the importance of getting pre-approved, understanding your credit and your FICO score. We covered down payment options, which vary based on your situation. And these are the things that you will want to discuss with your loan officer that will be specific to you. So you want to make sure and talk about these if you have any questions. So you're going to have closing costs based on the loan program and the property that you have chosen. So get some more information about that. You now have a basic understanding of conventional versus unconventional loans. Make sure you're in the right program for you. You know what makes up your mortgage payment. So your PITI, make sure you have a PITI that meets your budget. And you understand the 6 steps to the home buying process. So the class is over, but you have only just begun. We're here to help guide you on your journey toward home ownership. Our team is always here to help. We're happy to answer any questions that you have. You can reach us by calling our office at 360-930-6021 or emailing us at team, TEAM, at themasongroup.loans.com. Thanks for watching.